Right now, somewhere in America, someone just quit their job forever. Not because they won the lottery, not because they inherited a fortune, because they figured out a number. One specific number that, once your investments hit it, means you never have to trade your time for money again. And most Americans have no idea what that number is for them. This is not about getting rich fast. This is not about hustle culture or some side hustle promise. This is about one of the most mathematically reliable ideas in personal finance. And once you understand it, you cannot unsee it. So what is the number? What does it actually take to live off your investments forever in America? The answer depends on one thing more than anything else. Not how much you earn, not where you went to school, not even how smart you are with money. It depends on how much you spend. Here is why that matters so much. There is a concept called the safe withdrawal rate. It was popularized by financial researcher William Bengen in 1994. Bengen studied decades of market data and asked a simple question. If someone retired and started withdrawing money from their investment portfolio each year, what percentage could they safely pull out without running out of money in their lifetime? His answer was 4%. 4% per year, adjusted for inflation, historically gave retirees a strong chance of never depleting their portfolio over a 30-year retirement. This became known as the 4% rule, and it completely changed how people think about retirement. Here is the math. If you can live on $40,000 a year, you need $1 million invested. If you need $80,000 a year, you need $2 million. If your lifestyle costs $120,000 annually, you need $3 million. You take your annual spending, you multiply it by 25. That is your number. Simple, brutal, and completely indifferent to your age, your career, or your background. Now, later researchers refined Bengen's work. Pfau, a professor at the American College of Financial Services, ran more recent studies accounting for today's lower expected market returns and longer life expectancies. Pfau and others suggest that for very long retirements, a more conservative withdrawal rate, closer to 3 or 3.5%, may be safer. That changes the multiplier from 25 to somewhere between 28 and 30, 3 times your annual expenses. That sounds scary. But here is the thing. It does not change the fundamental idea. It just means the target might be a little higher than you thought. So let's talk about what that actually looks like for real Americans. The median household income in the United States is around $75,000 a year. If someone in that household spends roughly $60,000 annually and saves and invests the rest aggressively, their financial independence number sits at around $1.5 million. That is using the 25 times rule. Does $1.5 million sound impossible? It is not. And the vehicle that gets most Americans there faster than anything else is compound growth in the stock market. Here is what that looks like in practice. If you invest $500 a month starting at age 25 in a low-cost index fund tracking something like the S&P 500, which has historically returned around 10% annually before inflation, you would have roughly $3.2 million by age 65. That is 4 times your financial independence target if your spending is $60,000 a year. But most people do not start at 25. And most people do not invest $500 a month in their 20s. So let us talk about what actually moves the needle. The single most powerful lever in this entire equation is not your investment returns. It is your savings rate. J.L. Collins, author of The Simple Path to Wealth, has written extensively about this. The more of your income you save and invest, the faster you compress the timeline. Someone saving 10% of their income might take 45 years to reach financial independence. Someone saving 50% might get there in 17. Someone saving 75% might do it in 7 years. This is counterintuitive. Most people focus on earning more. And yes, income matters. But if your spending always rises to meet your income, you never close the gap. The gap between what you earn and what you spend is the engine. Everything else is noise. Now here is where dividends enter the picture. One of the most popular strategies for living off investments is building a dividend portfolio. Instead of selling shares to fund your lifestyle, you collect the cash payments that companies distribute to shareholders. These are dividends. And some investors build their entire retirement strategy around collecting enough dividend income to cover their annual expenses without ever touching the principal. This approach has genuine appeal. Your portfolio theoretically keeps growing while you live off the cash it throws off. You are not drawing down your pile, you are just harvesting the fruit while the tree keeps growing. How much do you need for this? It depends on the yield. The average dividend yield of the S&P 500 hovers around 1.3 to 1.5%. That is low. If you want to generate $60,000 per year in dividends from a broad market index, you would need roughly $4 million invested at a 1.5% yield. But dividend-focused portfolios can be structured differently. High dividend ETFs, dividend growth stocks, REITs, and other income-generating assets can push that average yield to 3, 4, even 5%. At a 4% dividend yield, you would need $1.5 million to generate $60,000 in annual dividend income. Suddenly, the numbers start to look familiar. The catch is concentration risk. Chasing yield can lead you into companies or sectors that pay high dividends now but may cut them later. A dividend cut in retirement, when you are depending on that income, is not just a paper loss. It is a disruption to your actual life. This is why diversification across dividend-paying stocks, sectors, and asset classes matters enormously. So what does a realistic path actually look like for an average American? Let us follow someone we will call Jordan. Jordan is 32 years old. Jordan earns $80,000 a year. After taxes, that is roughly $60,000. Jordan currently spends $50,000 and invests $10,000 a year. At that rate, investing in a diversified index fund portfolio, Jordan reaches $1.25 million in about 30 years. Financial independence at 62. A respectable result, but not life-changing. Now suppose Jordan gets intentional. Jordan cuts annual spending to $38,000 by making a few deliberate choices. A less expensive car, cooking more at home, reducing subscriptions and lifestyle inflation. Jordan now invests $22,000 a year. Jordan also gets a modest raise over time, bumping investments slightly higher each year. In this scenario, Jordan reaches the $1 million target, which covers that $38,000 lifestyle at a 4% withdrawal rate in roughly 20 years. Financial independence at 52. An entire decade reclaimed. That is the power of the gap between income and spending. Not luck, not timing, not crypto. The gap. Now let us talk about what happens between here and there. Because reaching financial independence is not just about hitting a number, it is about what you invest in and how you structure it. Most financial planners and researchers agree that a simple, low-cost, diversified index fund portfolio is the most reliable vehicle for the average American. Vanguard founder John Bogle spent decades arguing this case. The data consistently shows that most actively managed funds underperform simple index funds over long periods after fees are accounted for. The enemy of compound growth is fees. Even a 1% annual fee compounded over 30 years can cost you hundreds of thousands of dollars. This is why the FIRE movement, which stands for Financial Independence Retire Early, has become so fixated on low-cost index funds. The Vanguard Total Stock Market Index Fund, the Fidelity Zero Funds, the Schwab S&P 500 Fund. These are the workhorses that millions of Americans are quietly using to build the number. But the number is not a finish line. It is a threshold. When you cross it, your relationship with work changes permanently. You can choose to keep working. Many people do. But you are no longer working because you have to. You are working Because you want to. Because it is meaningful. Because it is interesting. Because it connects you to something. The financial pressure disappears. And everything that remains is real. That shift, from working to live to choosing how to spend your hours, is what the number actually buys. Not luxury. Not indulgence. Freedom. The freedom to wake up on a Tuesday and decide what matters to you without your bank account having a vote. Here is the thing that most financial advice never tells you. The number is not as far as you think. You do not need to earn $200,000 a year to get there. You do not need a high-powered finance job or a startup that exits. You need a clear picture of what your life actually costs. You need a savings rate that is meaningful. And you need time and compound growth to do the heavy lifting. If you spend $60,000 a year, your number is $1.5 million. If you spend $40,000, it drops to $1 million. If you spend $30,000, it is $750,000. That number is reachable on a median American income. In 15 to 20 years of disciplined investing, without ever picking a stock, timing the market, or making a single spectacular decision. Just the gap. Invested consistently. Over time. Right now, someone in America just quit their job forever. They figured out their number. They hit it. And you are closer to yours than you probably realize.